There is a lot of misnomer in the world about how billionaires and super rich people optimize their taxes. I'll see these comments online all the time from people making all sorts of bizarre statements for anyone who actually knows how it really works about, people hiding money offshore and all sorts of loopholes and things like that. The truth is what I'm going to talk to you about today. So today we're going to discuss billionaire tax optimization, and this certainly may surprise you. Welcome everyone, I am Michael with Offshore Citizen. If you have not been here before, please take a chance to check out some of our other videos, hit the subscribe button, hit the like button. Thank you for being here, and if you'd like help with the things that we help with, which is global, holistic, customized solutions for you, then we're talking about where to live, getting residency permits so that you can legally live there, have Plan Bs, get second citizenships, do international banking, optimize your global tax for yourself and your business, invest abroad. All these sorts of things are what we work on. And if you'd like help with any of those, we can help you both with figuring out the best solution for you and implementing it. So please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer. There's a link in the description below, or send a message through offshorecitizen.net and we'll be happy to help you. Okay, so we know for sure what billionaires typically do not do, and that is they typically do not put themselves in a position where they're evaders, okay? Generally, billionaires are not evading taxes. Why not? Because they get an enormous amount of scrutiny. So when you're a small fish, you're not going to get audited very often. The reason is that the return on that audit is probably pretty low. The likelihood that they're going to catch you for much is not very high, and the amount of money that they get if they do catch you is probably not very high. So tax departments need to prioritize their resources where they think they're going to get the best return on investment. And as a result, billionaires and super rich people get a lot of focus. It would be very normal to get audited every single year, okay? So not a pleasant thing, but it is what it is. So as a result, they need to be more careful about a lot of details than many other people would do. So typically billionaires are not tax evaders, okay? Number two, billionaires typically are not using some fancy offshore tax structure the way that a bunch of other people might be. Not to say that they can't, not to say that some of them don't, certainly some do, but in general, their tax solutions are, we'll call it much more benign and sort of much more practical to focusing on wealth building. That's probably how they got to where they are, was focusing more on wealth building than they were on tax savings. Tax savings matter, of course, but in a relative basis, it's a lower priority. And I talked a little bit about this in an earlier video, maybe a week or so ago, where I was discussing how Chamath Palihapitiya was mentioning, don't try and optimize your tax. And certainly there is different contexts for that, and you can't, you can go and watch the video and talk about, how I see that things are changing from where they were typically. But it's more focus on upside, less focus on downside. So that's the next thing. The third thing that they're typically not doing is benefiting from some fancy loopholes. For the most part, first of all, the tax code is the same for everybody, okay? So everything that is available to the super rich are available to people who are not super rich. Now, granted, it may have a different ROI, but you don't have to make that much money before there starts to be ROI in various different structures. So that's usually not what's going on there. What is going on is that the tax code is designed to favor, in most cases, certain types of income. And here we need to get into the subject of understanding how wealth is built, okay? A lot of people tend to focus on income because that's where they started. They were in a position where they maybe went and got a job and they got paid for their time. And so they think that wealth equals what you earn. The reality is wealth is not what you earn. Wealth is what you own. And this is the big thing that changes the equation for super wealthy people. Why does this change the equation? Because there is always and only three ways to save on tax, okay? So every tax strategy in the world, no matter where you are, no matter what tax system they have, no matter what different structures they put in place to try and cage people in, there are only three ways to optimize tax. This is, you can lower your tax rate, you can reduce your taxable income, mainly through deductions, etc. And number three, you can defer, okay? Deferral happens to be this highly underrated form of tax savings. Very, very important. Now, if you're talking about, say, if you're in Canada, you have like a TFSA, you have an RRSP. If you're in the US, you have 401ks, you have Roth IRAs. If you're in Australia, you have superannuation plans, etc. A lot of countries have some sort of a plan to allow for tax deferral. Usually this is capped pretty small, and so it doesn't gain a lot of mileage. But it turns out that certain types of assets inherently allow deferral, meaning that you can compound the growth of your wealth without having to be taxed along the way. And this is the first secret of billionaires. Billionaires tend to make their money mostly from the value of their company. So it's not through the cash that they accumulate. Very often billionaires are fairly cash poor. They generally don't have a lot of cash sitting around. Now, maybe in later stages they will, but certainly early on they don't. Most of their value is in the value of their company. And the beauty of this is when they started, they might have invested a few $100,000 into the company, and the company has grown to a value of billions of dollars. And how much tax have they paid along the way? Zero. They have not paid any tax unless they sold shares. Okay, so long as they don't sell, they don't pay tax. That is like the first big billionaire tax optimization strategy. Okay, you got to compound all along the way. Your company could be growing at a rate of 20, 30, 50, 100% per year, and there's no tax. And if you just think about this, imagine you have a company that was worth $50 million last year, and now this year it's worth $75 million. Now, if you had earned, so your net worth went up by $25 million. If you had earned $25 million, you would have been taxed heavily on it. How much did they pay? Nothing. And they don't pay until they get to the end, when they actually start liquidating. This brings us to the second point. They don't need to liquidate very often because they can borrow against those assets. So what are they going to do? It's very common. There are various banks that if you have sufficient net worth and a sufficiently solid asset, you can go to them and you can pledge your shares. You can say, all right, I'm going to put up, let's just use Elon Musk as an example. He can secure a portion of his Tesla shares. Maybe he just goes and he takes, 5%, 10%, whatever the number, depending on how much money he needs. And he may get, a $1 billion loan. Now he has $1 billion he can spend. How much did he pay in tax on that? Zero. So he's benefiting from that value of deferral. He's essentially taking a loan from the tax department. All perfectly legally, no loopholes, no anything. It just happens to be the way that the tax system works. This brings us to the next thing. They get to benefit from write-offs, right? They're always in a situation where they can maximize various write-offs. If you go and you look at Donald Trump's tax returns when they were leaked from back, whatever that was in 2019, something like that. What happened around then was they discovered, he hasn't paid tax hardly at all in years. Why not? Well, because he had deductions from losses that he had taken previous years, and in particular, he was in real estate, and real estate happens to allow you to have depreciation. And so he could use the depreciation to offset his gains in, say, The Apprentice and not pay taxes. And this brings us to the fourth point, which is they benefit from capital gains. So generally speaking, investment income is taxed lower. Usually, it depends on where. In some countries, it's not taxed at all. So for example, if you're in Singapore, if you're in Malaysia, if you're in Hong Kong, etc., capital gains aren't taxed at all. So that's really good. But if you're in high tax countries, like Canada, like the US, like UK, then you're in a situation where your capital gains are taxed at a much lower rate than the regular earned income rate. So not only have you grown the money without having to pay tax along the way, not only have you been able to defer by borrowing, not only have you been able to offset your gains through various deductions and write-offs, etc., but when you do finally realize those gains, you're probably paying half the tax rate, maybe lower, versus a normal earned income on a similar amount of money. And so Warren Buffett famously came on TV and showed how his tax rate was much lower than his secretary's tax rate, even though at that year, I think he'd claimed like $90 million or something. Hadn't used any tax tricks, nothing offshore, nothing fancy, etc. The only reason for this was his money came from capital gains and hers came from earned income. That simple advantage gave a huge, huge advantage. And so, yes, ultimately, somebody like Bill Gates has paid a lot of tax in pure number terms, right? Somebody like Elon Musk has now paid a lot of tax in pure number terms. But as a percentage relative to the growth in wealth, he's been able to optimize pretty well without having to do anything crazy. And so I think the key lesson for you here is understanding that wealth is built in ownership. That's the first thing. Second of all, if you invest in something long term and you're able to grow that, you can grow it exponentially much more. It's very, very hard to build cash flow equivalent to that level of money. But you're also going to get benefit from the tax system itself. Essentially, the tax system is designed to favor people who are thinking and working long term. And you can increase the value of your company dramatically. You can increase the value of your real estate dramatically. And it turns out that over time, you're borrowing against this. And get this, as a kicker, when you're borrowing, the interest that you're paying becomes a write-off that you then can go and offset taxes on other income that you receive. So it all kind of works together pretty nicely to give what is, a relatively low net tax rate. And the net tax rate comes without having to be hit with it year after year after year. In fact, probably not for potentially decades, depending on the life of the billionaire and what in particular is going on. So I hope that helps. Hope it gives you a clear sense of what's going on. Now, obviously, there are other ways to do international structuring. You can certainly relocate to other countries where there is no tax. You can relocate to countries where the taxes are much more favorable. Certainly, there are ways to set up structures that are good for other types of income, as well as relocate so that other types of income are low or no taxed. And that might be really beneficial to you. However, it is not what a lot of these billionaires are doing. And to be fair, most people are not in the situation of those billionaires. So you have to do what's good for you. And if you'd like help with any of that, we're happy to help you. Please reach out to us. Again, you can book a call. If you like the video, give it a thumbs up, share it with your friends, subscribe to the channel, and I will look forward to seeing you on the next video.